Hey, do you know the UK tax can limit the interest deduction? If not, then this video will be helpful for you. In this video, we will cover three aspects. One is what is CIR. The second one is why government come with this restriction. The third one is the three main tests under these rules. So the first thing is what is CIR? So corporate interest restriction is nothing but a set of UK tax rules which says like how much interest a company or a large taxpayers or a multinational group can deduct while computing their corporate income tax. Now think why government come with this restriction. The government objective is to prevent the multinational group or the large taxpayer from reducing their profits by claiming excessive interest deduction. These rules actually, try to ensure that the company can claim the interest deduction which should match with the real business activities taxed in the UK, and the company should not claim excessive interest reduction just to tax or just to cut their UK tax bills. So that is the main objective to implement these rules. Now let's understand the three main tests which is mentioned under this rule. So the first thing is the threshold. There is a threshold of 2 million GBP. That means if your interest expenses, the net interest expenses is less than 2 million GBP, then you are not falling under CIR. That means no corporate is falling under CIR and they can claim the whole interest while computing their corporate income tax. The CIR comes into play when the net interest expenses is more than 2 million GBP. So the first test is fixed ratio test, which is a default test. That means if your interest is over and above 2 million, you will fall under the fixed ratio test, and you need to check whether this test is giving a better deduction for you or not. So this test actually to evaluate how much excess interest deduction you can claim over and above 2 million GBP. That is a de minimis threshold. So under fixed ratio test, it says like your deduction is limited to 30% of UK tax EBITDA. Let's understand with a very simple example.
So in this example, the excess deduction is 1 million, that is over and above of de minimis threshold of 2 million, and the 2 million which is disallowed, that can be carried forward for an indefinite period.
Let's understand what is group ratio test. So under this group ratio test, a multinational group or a taxpayer can apply, instead of applying a 30% cap, in case the multinational group or that company is having a high external borrowing. That means if that company or the large taxpayer in their consolidated accounts is having a high interest, external interest, then they can apply the group ratio test, which is nothing but the external interest which is reflected in their consolidated accounts divided by the group EBITDA. Let's understand with an example again.
In this example, under group ratio test, the deduction is 120 million GBP, which is better than the fixed ratio test where the deduction is 60 million GBP.
One thing to be noted, like in case your company is having a high intercompany debt and less external borrowing, in that case the fixed ratio test will be more beneficial. Why? Because when you are preparing the consolidated accounts, your intercompany debt or intercompany interest will be nullified each other. In that case, your external borrowing will be lower. So in that case, fixed ratio test will be beneficial. So let's understand with an example, then it will be clear to all of you.
So in this example, under group ratio test, the deduction is 10 million, whereas under fixed ratio test, the deduction is 60 million. That means a group which is having a low external third-party debt, fixed ratio rule always be more beneficial.
Now the third one is the public infrastructure exemption. So public infrastructure exemption is nothing but a special provision that allow the companies who are involved in the public infrastructure projects to deduct certain or most of the interest in their calculation. So This provision is specifically applicable to the qualifying infrastructure companies. To meet the qualifying infrastructure companies, a company is required to meet the following 4 tests. One is the most of the income of the company should be from the public infrastructure projects. The asset must be used for public infrastructure. The company is fully taxable in the UK, and the company is required to formally elect themselves as an QIC. So if these are meet, then the company can deduct most of their interest. That means the normal test will not be applicable to these companies. So the company should choose the test which would give them the better deduction. I hope this video is helpful for all of you, and thanks for watching.